Hello and welcome to another episode of Property Ponderings, the podcast where we dig deep into the world of property buying, selling and renovating, giving you expert advice to ponder. I'm Craig Nicol, your host. I'm a licensed real estate agent at Nicol Real Estate in Melbourne, Australia, with over 15 years of experience as an agency owner, property investor, renovator, town planner, salesperson, auctioneer and buyer's agent. My goal is to help you make better property decisions whether you're buying, selling or investing. Now today's episode is a must listen for anyone active in the property market right now. We're breaking down the latest data from CoreLogic's February 2025 market reports, including auction trends, home values, rental market shifts and what's coming next for buyers and sellers. So by the end of this episode, you'll know how auction clearance rates are shaping up post-festive season, what's happening with home values across Australia, where rental markets are heading and how interest rate expectations are influencing demand. So let's dive in. Alright, so for the auction market update, February 2025, auction markets are ramping up as we move out of that festive period slowdown. So about 1,400 homes went under the hammer last week nationally, up from just 429 the previous week. Whilst this is a solid increase, auction volumes are still down 313 auctions compared to the same week last year. So let's look at some of those clearance rates. In Sydney, 67.5% of auctions were cleared, which is up from the 60% the previous week. Melbourne, 65.4% clearance rate, slightly better than the previous week. Brisbane sitting around 60%. Adelaide at about 60% as well, and Canberra closer to 70%. So auctions are back in business after the holiday break. If you're looking to sell, now is the time to prepare before activity peaks leading up to Easter. All of those clearance rates sitting around neutral. Canberra, slightly higher clearance rate, closer to 70%, but around that 60 to 70%, we're looking at a fairly balanced market in general. So nothing too alarming or impressive from those numbers for this time of the year anyway. We do have lower volume, so it doesn't really mean as much until we see some higher volumes, and if those percentages stay where they are or increase, then that can be a sign of an improving market. But if we do see those numbers dropping from that ballpark of about 60-70%, then we're starting to see the entering of more of a buyer's market. All right, the next thing I want to look at is home values and the market performance across the whole of Australia. So the latest CoreLogic Home Value Index showed a bit of a mixed picture. So for declining markets, Melbourne, so still a bit on the nose for everyone. We've seen home values there drop 0.6% in January, and they're down 3.3% over the past 12 months. Sydney down 0.4% for the month, showing a few signs of weakness as well. And if we look at Canberra as well, also saw a decline of 0.5%. Now, if we look to the markets that are still growing, Perth still leading the country with 17.1% annual growth. Adelaide, it's up 12.7% over the past year, and Brisbane, a strong 10.4% annual increase. The National Home Value Index showed an overall 4.3% increase over the past year, but the pace of growth is slowing, especially in the capital city. So a lot of that 4.3% increase would have been in those key cities just mentioned in Perth, Adelaide and Brisbane, and then being dragged down by places like Melbourne and Sydney. So in this report, they mentioned three key driving trends. So firstly, rising affordability constraints. So Sydney and Melbourne buyers are really feeling the pinch where traditionally pricing and costs are the most expensive. The second trend that they noticed was interest rate expectations. So that potential rate cut is on the horizon, but borrowing still remains tight, and that's what's having the ultimate impact on markets. So there's more money moving to those more affordable markets around Australia, which are now becoming less affordable than they certainly were. So places like Perth and Adelaide. The third trend that the report mentioned was just the low housing supply. So particularly Perth and Adelaide, quite a low, tight supply, which is keeping those prices really high and seeing some good growth there. So those are the three trends. that they think are really important, which I would agree with. Affordability constraints, interest rate expectations are certainly playing a role in the market, in people's mindset, although there's no real impact yet because interest rates haven't changed, so the borrowing is still tight. And then also that low housing supply in certain markets. All right, and then let's look at the rental market trends. So the good news for renters here, after 5 years of extreme rental growth, prices are finally stabilising. So national rents rose just 0.4% in January, which is in line with the slower trend which has been seen since late 2024. That is still an increase, which isn't great from a renter's point of view, but that slowing increase certainly might provide some reprieve. The other important thing is the annual rental increase is now at 4.4% nationally, still higher than that pre-COVID decade average of just 2%. In Sydney and Melbourne, rents actually fell in the past 6 months according to the data, so minus 0.4% in Sydney and minus 0.6% in Melbourne. Perth again still leads the pack with a gross rental yield of 7.4% on its properties, and that may be attracting more buyers as well as people's ongoing cash flow is really significant in their investing decisions and being able to hold properties. So that is an attraction for Perth. Now, 3 factors that they note are behind the rental slowdown. So affordability constraints, tenants can't stretch their budgets much further, and we might be seeing budgets hitting that absolute top point where even if rental asking prices went up, there's no one there that is willing to pay that money, which is going to put a bit of a top on what rents can get to. Slowing migration is being seen, so fewer international arrivals, potentially reducing that demand. And then also the third factor they mentioned was larger household sizes, so more people are moving in together to try and cut costs with the affordability and lifestyle constraints. And so this is a bit of a positive sign for renters, but investors should really take note. Rental yields may soften further if prices do stabilise at lower points. So something for investors to think about there, and not plan on having huge rental increases into the future year on year. There may be a stabilising or even a little bit of a retraction to be aware of when you're trying to assess your cash flow moving forward. And so the last thing I wanted to discuss was interest rates and market sentiment. What's next? One of the biggest factors influencing the market right now is interest rate expectations. Markets are pricing in a 95% chance for a rate cut by February 18th, with up to 4 rate cuts expected this year. So if this does happen, borrowing power will increase and we could see renewed demand for housing. However, the RBA is still cautious, warning that high household debt could lead to tighter credit policies. So for buyers, this means if rates are cut, borrowing capacity will improve, giving you more purchasing power. It also means though, if you're waiting to buy, now might be a good time to prepare before the market reacts. And trying to time when the market may bounce or rise, especially in places like Sydney and Melbourne, can be extremely difficult. So if you're ready to buy now, I think there are some wonderful bargains around, but also there are limited good properties available, if that makes sense. The supply might be at a pretty medium sort of level, and there's plenty of properties around, but a lot of them aren't very good. So just be wary there. But if you are ready to buy, it could be a good time to jump in, because I think that if the markets in Melbourne and Sydney do jump based upon interest rates and changes, then I think you could see a pretty rapid response to that, and quite a sharp rise in prices if it does occur, as everyone won't want to sit on their hands knowing that that rate cut may well get more and more buyers involved in the market, and it can turn into a really competitive situation. Of course, that might not happen, but I just think these days the way that the investment markets seem to work is that once one person hears that the market's improving, suddenly everyone knows, and things happen quite quickly. So, and this is especially the case in bigger cities. And that goes both ways, so things can drop quickly. But I think at this particular point in time, I think those two big cities are ready to really jump in price. So I think you have to be really ready for that. With all these changes, with interest rates for sellers, lower interest rates could bring more buyers into the market, so helping properties sell faster from your point of view. But also for sellers, affordability issues remain, so realistic pricing will be the key. The market hasn't jumped yet based on interest rates. It might not actually go up when interest rates go down. We don't know 100% what's going to happen, so being aware of that and pricing your property accurately is going to allow you to get maximum competition on your property to push it up to where it deserves to get. We all know the challenges of overpricing your property and hoping for the best can really do some damage to your overall end result. So a few key takeaways from this episode, which has given us a bit of an update on what's going on in the market at the moment. So for buyers, if you're looking into Sydney and Melbourne, you may have more negotiating power as prices are softer now, and they could still soften more, depending on what interest rates do, as we've discussed. But if you're in Perth, Brisbane and Adelaide, you're currently still preparing for competition. Prices are still rising, and so don't expect things to be easy there at this stage in time. And then also just watch interest rates closely from a buyer's point of view. A cut could drive up demand very quickly, so be aware of that. For sellers, auction clearance rates are improving, so making it a good time to potentially list your property. I think that the really big thing is if you do have a really good property or a good property that you think will get competition, with the way that, I can speak for Melbourne, the way that the market currently shaping up, there are lots of properties on the market, but not that many good ones. So if you do have a good one you put on the market, I would be expecting that you would be getting really good competition at this current time in the market. Waiting later on, a little bit more closer to Easter, you may see that more good properties come on, and you may find that you have a bit more competition. The other thing for sellers is just continuing to remember that pricing realistically is really important. Overpriced homes are sitting on the market for longer, and again, especially in Melbourne, we've seen properties that have been sitting on the market for well over half a year or a year that are just not going anywhere because they're priced too high. And in the long run, even if they take that off and then put it back on, I believe that the pricing of being a bit of a market lemon, I guess the stigma of being that market lemon that's been sitting on for so long can really hurt you in your price down the track, because people remember. Also remember, I know it's a bit challenging for sellers, but if rates are cut, the buyer activity may increase. So you may see that trying to time that demand can be quite difficult. Like, you don't know that if interest rates are cut, then you might see a quick spike in buyer activity, and that could be a good time to sell. Or do you wait because more interest rate cuts will come, and then will prices keep rising throughout that period as well? That's really challenging to try and do. So try and remember that from a seller's point of view, that your own particular situation is really going to guide you on that. Like, if you are buying again in the same market, are you buying a more expensive property, or are you buying a property that will be cheaper? So if prices are rising in a market, it tends to be a better environment for you to actually downsize at that point, because you're selling a more expensive asset that has gone up in value and is rising rapidly while you're buying a cheaper one. But if the market's going down, then you're better to be upsizing, because the cheaper value of your property, yes, you may take a bit of a haircut on your value, but for the property that you're buying that is probably more expensive for the upsize, that will also have taken a hit, and it would normally have taken more of a substantial hit in regards to the absolute value of the cash. So that puts you in a better position. So try and think about your own situation. If the market does turn and starts rising, what's going to be best for you in that longer run? Are you better to rip the band-aid off and just sell sell now so that if the market does keep going up, that you're in a better position? Or is it the reverse? Are you better to wait and sell later and wait for the conditions to change? So there are a lot of different variables, but that's just a few quick examples of some important basic thoughts or foundational thoughts that will start the conversation if you're trying to time things. But as always, timing is impossible. So you're just doing your best to try and make smart decisions with as much information as you can. But it's not a pure science. So for investors, the other things that I want you to take away is that rental yields are holding up, but they're slowing. There's a slowing growth, which is starting to stabilise. So don't be planning on lots of rental yield rises into the future at the patterns that have been happening in the last few years. For investors as well, Perth and Adelaide remain strong. Melbourne and Sydney are cooling off, and I know a lot of investors are keeping that in mind. As opportunities are plentiful in these bigger cities. So if you're looking to buy, then that could be Sydney and Melbourne could be great locations for you to buy as you're looking at properties now that are on the market, depending what area you're in, of course, but there's some significant discounts out there compared to previous peaks. And not saying that they'll definitely get back to where they were or when they will, but some people, depending on your investing strategy, see that as an opportunity to buy when the market has bounced and fallen from its peak, and there's a small little gain to be made on certain properties when the market, say, returns. So keeping all that in mind. And the other thing is just to keep a keen eye on government policies and potential APRA lending restrictions should there be further changes if the market does take off after there are some interest rate cuts that are likely, by the sounds of it, to be coming. So that's it for today's property market update. As always, the market is shifting and being informed is your best advantage. So if you're planning to buy, sell or invest and you'd like tailored advice, please feel free to reach out. You can contact me on 0400 122 081 for some more expert property insights and some guidance on what you need to do next. But until next time, happy house hunting. We'll chat again soon.
The information provided in this podcast is for general information purposes only and does not constitute financial, legal or investment advice. While every effort is made to ensure the information shared is accurate and up to date, it may not apply to your specific circumstances. Listeners are advised to seek independent professional advice tailored to their personal situation before making any property, financial or investment decisions. Nickel Buyer Advisory and Craig Nickel disclaim all liability for any decisions made based on the information discussed in this podcast. Property markets are dynamic and outcomes can vary depending on factors such as location, timing and economic conditions. Always conduct thorough research and